The next talk we have is by Ian Dew-Becker, who is a professor at Northwestern, someone whose research I followed closely, has been doing a lot of work on real options, and he's going to tell us what synthetic real options can tell us basically about risk preferences. And Jamil of PIMCO is going to discuss. And I think I'll try not to come up here between the talk and discussion, but let me turn it over to Ian now. Thank you very much, Ian.
Okay, so I want to thank the organizers very much for for inviting me to present here. It's obviously like an incredible place to be presenting and sort of an intimidating audience. And so let me tell you what we're doing. So this is joint work with Stefano Giglio, who's at Yale. And what we're trying to think about in this paper is what options tell us about investor preferences, right? So options can be used, so Myron talked about this yesterday, options can be used to understand state prices, right? So what are investors paying for a dollar in different states of the world? And when we look at options, the historical fact for both put options and call options is that relative to the CAPM, they have a negative alpha. So I'll show you that in the data. Lots and lots of people have found this. You can do it lots of different ways. And the question is, what does that tell us? When we see this negative alpha, it's negative CAPM alpha on traded options on the S&P 500s. That's everything I'm going to be focusing on is the S&P 500 today. When we see those negative alphas, what do we learn from that? So what I'm plotting here in this graph on the right, the blue line is marginal utility, so the value of a dollar in these different states under the CAPM, right? So on the x-axis, we have the return on the overall stock market. On the y-axis, we have marginal utility, or the value of a dollar there. The CAPM, you have that linear marginal utility, so you have just quadratic preferences is how you get there. And so that's telling you when things go down, when the market's doing poorly, those are states that investors value highly. And the orange line is what we get if options are overpriced, if they have a negative alpha relative to the CAPM. And so what that's saying is that if put options are really expensive, it must be that investors really hate those big down market states, right? They're willing to pay a lot of money to hedge those states. That could be because they hate crashes. It could be because they hate high volatility, right? That how do you get into these extreme states? It's got to be that volatility was high. So this could be a variance risk premium that would generate this, and that's how a lot of people talk about it. Could be that risk aversion goes up in bad times, and that causes people to be highly averse to those states. The other possibility is that options markets are segmented in one way or another from equity markets, right? That instead of this being about the preferences of the kind of typical equity investor, this is more telling you something about the preferences or the constraints or the hedging ability of intermediaries who are trading options, right? So it might be the average equity investor can't really freely sell options, and the alpha that you're seeing is representing some sort of premium that's arising that could be because of hedging risk, it could be because of liquidity risk that dealers or market makers or specialists in options face. And so we want to try to think through that in this paper. And so what we're going to do in this paper, I'm going to show you two empirical results that we have. So what we're going to do, the main thing that we're going to do is we're going to look at synthetic options. So we're going to dynamically replicate options. We're basically going to do what you would do if you were trying to hedge an options position, which is to say that you're going to have the delta, that Black-Scholes delta is going to be your position in the underlying. So you're going to be updating your position once a day and use that to try to replicate the return on an option. And we know that shouldn't be perfect, but it's going to work surprisingly well. And we can do that for nearly a century. We can do it back to 1926. We're going to look at daily data on the overall stock market. We're going to try to replicate the return on an option. When we do that, we're going to find a payoff that is going to be very similar to actually a traded option, to what it should do. But the average return is going to be vastly different. The average return is going to be very close to zero. It's going to be entirely consistent with the CAPM. Whereas again, the average returns historically, if you go back to August 1987 when the monthly index options start, what we see is those massively negative alphas on the traded options. So fact number one is the synthetic options do not earn a negative return, don't earn the negative return that we see on the traded options. Fact number two, though, is that those traded options, while they used to be expensive, they used to have that negative CAPM alpha, that's gone away, and their returns have converged over the last 15 years to the returns on the synthetic options. Another way to say that is that the returns on delta hedged S&P 500 options used to be very negative, and they've gone to zero. So I'll show you those two facts. What we're going to argue is that that's consistent one, with past work. It's consistent with findings of no arbitrage, the no arbitrage literature. The novelty here is we're going to go much further back in time, and we're focusing on those synthetic options, number one. And number two, we're going to look at changes in these premia over time and argue that non-stationarity, these changes in returns, are actually important, actually very, very important. And that this is all consistent with a story where intermediaries are important in driving this pricing, and that you don't necessarily want to take. And the question is kind of how do you interpret option prices, right? When you look at option prices, is this telling you something about, like, are the returns on options telling you something about the preferences of a typical investor? Like grandma's going investing, is it that she really hates tail risk and she's getting protection from that in one way or another? She might be doing it via, say, like a life insurance policy that has optionality. Is she pushing the prices around? Is it the standard kind of investor for retirement? Or is this driven by frictions and intermediation? We're going to argue that it's consistent with intermediation. So what are we going to do? What we want to think about, we want to put some theoretical structure on this to think about what options tell us about preferences. And so what's going on here is we're going to think about the return on an option. We'll call it RO. And we want to use that to reveal something about marginal utility, right? About state prices. And so what I'm plotting here in green is the return on an option. On a plain vanilla option, I have the return on the market on the x-axis. I have the return on the option on the y-axis. What we're going to do is orthogonalize that with respect to the market. So I want to just take out a static position in the market. So what you're going to do, the orange line, what is that? That is just, you bought an option, you bought a put option in this case, and you also bought some of the S&P 500 so that you have a portfolio of 0 beta. That's going to be convenient for us. You haven't done much at this point. You have a payoff that looks like a straddle. But that's going to be useful for what we want to do. So if you're an empiricist, say if like you're just you could be like a applied microeconomist, you could be somebody who just likes to run regressions, right? And you want to run a regression and you want to think about a kink somewhere, right? So I could say, so what I want to think about is I want to understand how do people feel about these different states of the world, and so that's the M bar. What are our preferences over these different states? That notation is just a term that's about returns over the course of the month. I want to think about returns in these different states, or preferences over these returns, as a function, one, of the return on the market. That's the RM. But maybe I think that changes depending on how the market's doing, right? Maybe I think it changes when the market goes really far down. Maybe people start to really hate declines in the market, and they hate them more than just your typical 1 to 5% decline. And the way we might try to get at that, I have a laser. The way we might try to get at that is with that piece, with this RO. And so that's my orange line here. I'm just running a regression, and the regression is of those state prices, of marginal utility in these different states. I'm regressing it on the market, so on a straight line, and on a kinked line, the orange one. So that's what that is. And I can always do that theoretically, and you get your ordinary least squares coefficients. That's this ratio. It's the covariance of that 0 beta return with the return on the market divided by the variance of the 0 beta return. The problem is I don't see that because I don't observe that marginal utility. That M is not observable. That's my problem. However, if options and equity markets are integrated, then we can actually, there's a trick. And the trick is that when the options are correctly priced by these state prices, then what we're going to get is that covariance is exactly the average excess return on that 0 beta options portfolio. And so that's useful then because I can figure out the kink in marginal utility in these state prices by looking at the alpha on the options. And so that's why I've been talking about this, why I've been talking about this cap M alpha, is that that's actually exactly what's going to tell me the regression coefficient when I regress these state prices, so the M's, on the market return, on a nonlinear function of the market return. So what does that look like? So this is what you get if you do that. So I have, again, on the x-axis, I have the market return. Again, we're thinking over the course of a month. So I could go from minus 20% up to plus 20%. And on the y-axis, I have the state prices. The straight line is what I would get if I just had the markets. That's just my cap M. And then the dotted line is what happens if I run that regression where I'm adding in the return on the put option. And so the put options have these big negative alphas. That gives me a a positive coefficient in that regression, and I get this big kink. And so what is that telling me? It's telling me that when I think about a regression of these state prices, of these marginal utilities on the market return, the option prices just tell us that investors really hate these negative states. So the valuations go way, way up in these really bad states, and again, they don't fall as much as the CAPM says for the good states. And again, that could be a variance risk premium. When volatility is high, that's how you get to those extreme states of the world. People hate those, and they're willing to pay a lot of money to hedge them. That's what you're seeing. These are just hedging costs. So what about a synthetic option? So a synthetic option, what I mean by that is we're just going to dynamically replicate a traded option, right? So we're going to use the Black-Scholes delta. We're going to have an adjustment from Hull and White where that delta, so the local sensitivity of the option to the market, that's your investment in the underlying, in the S&P 500, and the rest of your money goes into the risk-free asset. So we're just going to use 3-month treasuries here. So you put delta dollars into the market return, or into the market, into the S&P 500, 1 minus delta dollars into the risk-free asset. This is the completely standard replication. We're just making the point, look, you could do it on any period you want. I don't have to do it when options exist, which is what people typically do. So how are we going to build this? I'm going to use daily data on market returns from Ken French. So this is just the crisp total market return since 1926. We need a volatility. Where we're going to get our volatility is, so normally you'd use the implied volatility from the option, right, to do your hedge. We don't have that because we don't have the options trading. And so we're going to forecast volatility just using a statistical model. So I'm going to have some forecast of vol. It turns out to not matter much at second order. We're going to lag our delta by a day to address the possibility of stale prices, which can induce some persistence in returns. That bias actually matters a lot in the early data. The data's, I was surprised at how messed up it is. So that we kind of think hard about. And again, we're looking at 1-month options. Everything here is just for 1-month options. So this, what I'm graphing here, I don't know, this graph sort of stunned me. I don't know. I should tell you what it is first before I tell you why it's surprising. So the x-axis, again, is the market return. It's the same thing I've been showing you. Every one of my graphs, it's the market return on the x-axis. On the y-axis now, I have the return on that dynamically replicated option. So I have 25,000 returns because we're looking at overlapping 21-day samples, right? So I have basically 25,000 days of data, and we can just move our window forward every single day. And the blue dots are the individual returns that we get. The red line is a kernel fit, so it's just a local linear regression to get a sense of what this thing looks like. And what you can see is it looks a lot like the return on a put option. So here we were trying to replicate the return on a 5% out of the money put on the market. I wouldn't have thought this would work. I don't know. I thought there was a lot of unspanned risk. I thought there was a lot of unspanned volatility. That should break this. I thought there were big jumps. That should break this. The jumps really aren't big enough. The unspanned volatility is not big enough to actually create huge problems for this. It works surprisingly well. There's a window, right? This is not, so the payoff here, when we try to replicate this option, you are not exactly getting an option, right? There are deviations, and there should be deviations. We're only doing this once a day, and so even if prices follow a diffusion, this shouldn't work. In addition, we do think that there are unspanned risks. There are other things going on. They should break this, but it works kind of better than I would have thought. So that's when I say synthetic option, I mean that. When I say 5% out of the money synthetic put, I mean that thing. And we're going to look at the returns on that thing if you did it. Now there's a question of if you could have done it, right? You would have had to trade. You have to be trading the market every day going back to 1926. Don't think you could have done that, right? And so that should be in the back of your mind, right? You should worry about that. But if you could have done it, what would have happened? So what I did here was I looked at what we're looking at is the 5 worst 1-month periods for the US stock market. So for every one of these big events, we say, what is the worst month you could have had? November 1929, the market return was minus 41%. The market return was minus 41%. The synthetic option, you got plus 31%. You would have liked to get 35, so this is a 5% out of the money put. So you were aiming for, I guess, it's 36 minus the 1% premium you had to pay, so that's how we get to 35. So you would have liked to get 35, you got 31. I'll take 31. Right? If I can get 31 in 1929, I'm happy. March 2020, so that, look, if you were on the floor, maybe you could have done it. Nobody else could have done it. March 2020, you could have traded SPY every day, right? If you're a regular person with a regular amount of money, there's no reason you couldn't have traded the S&P 500 once a day. And if you had done that to try to replicate the return on a put option, a 5% out of the money put option, you would have gotten a return of plus 25%. You wanted plus 28, you didn't totally nail it, but you got a pretty nice amount of insurance really for free just by trading dynamically. 2008, you do okay. 1987 is a little tricky, and we can talk about it because it's super interesting and I think kind of central to what we're doing. And then 1931 is your fifth worst, and you do pretty well there too. So that's, again, this is the thing we're looking at. I'm going to show you returns on this thing, okay? So what do the returns on that thing look like? The red line is the cumulative CAPM alpha. So every month I'm going to get an alpha from doing this, right? I have this 5% out of the money put. I'm just going to take a static position in the market to strip out the beta part, and I'm going to look at the cumulative excess return from doing that. Okay? The blue line is what you would get if you did that with traded put options. So every month you buy a 5% out of the money put option, and you're going to have to buy some of the market to get rid of the beta. The red is if you do it with the synthetic option. And those lines are not the same. So the traded option shows the standard fact that we kind of learned from the literature and that a lot of people have implemented professionally, which is that if you are buying put options on the S&P 500, you're getting killed. And if you're selling them, there's a lot of money to be made, right? There are large alphas from doing that. We can talk about like technical issues in doing that, but these are all like mid prices, and there are all sorts of subtleties in how you actually implement this. But the point is that the returns that you get from the traded option are vastly different from the returns that you get on the synthetic option. So the synthetic option is here in red. And if I was trying to dynamically replicate that synthetic option, I get alphas that look close to 0 over the full sample, right? So they average slightly positive. It's not statistically meaningful. They are essentially 0 over this period. And so they're drastically different from the blue line. However, if you look at that blue line, it kind of looks like it's flattening out at the end, right? By about 2010, we see that line starting to flatten out. And it is not just like diving down the way it was earlier. That's number one. Number two, if you look at these two lines, if you look at their variation month to month, it's surprisingly similar, right? So we have these two different investments that look very correlated month to month, and that's essentially what this table is showing you. That's essentially what this graph is showing you. They look very similar month to month, but they have drastically different averages. And so that makes you wonder. That looks wrong, feels wrong. Now, I said we can use this to think about marginal utility, about these state prices, right? So I already showed you this for traded options. What I'm showing you here is the same thing, but for the synthetic options in red now. So again, I have my line for the CAPM. That's the straight solid line. That would just be linear marginal utility. So it says, again, people don't like these states with negative market returns, and just in a linear way. The puts tell us that marginal utility is significantly convex, so people really hate the left tail. They really would love to hedge crashes. You look at these synthetic put options, though, and we actually don't see that. We don't see that at all. Instead, if anything, we see concavity, right? And that's coming from that slight positive alpha that we see in the data. It's not statistically significant. We can't reject the hypothesis that it's just linear. It basically just looks linear. So again, we get drastically different answers here. Why is this important? It says, look, maybe people actually are not that terrified of the left tail, right? There is, again, this view that a lot of people really hate crashes and are willing to pay a huge amount of money to avoid them. This is inconsistent with that. Because you can avoid them, certainly now you can avoid them by just trading every day. To kind of dive down into that a little bit more, what we're plotting here is those alphas on rolling 10-year windows. Okay, so if we just look at the graph on the left, we're looking at, so our data starts in August of 1987. So the blue line for the traded options, so this first point, would be the information ratio. So the ratio of that CAPM alpha to the residual volatility, the volatility that you face. The information ratio from buying 5% out of the money puts between 1987 and 1997. your information ratio is -0.5. Right? So you were paying a lot of money. It's about the market, the Sharpe ratio on the overall market is what you're paying for that. And it stayed negative, right? So this point would be 1990 to 2000. This point would be 95 to 2005. And really right around there, which is also where a lot of other anomalies start to go away, where like value starts to not do so well, where momentum starts to not do so well. At that point, that's where you see this start to trend up. And those big negative returns on options have started to shrink significantly. Until by the time we get out past, so just before, so there's COVID, so that straight line, it's where you made a ton of money in one shot on your options. Even prior to COVID, though, a lot of that premium was gone, right? Even prior to COVID, the returns that you got over the last 10 years were nothing like what you were getting early on. The red line, again, is for my synthetic options. That red line is positive through this whole thing. You were earning a slightly positive alpha through this entire period. And so what's going on? So you could have, so we see this convergence. So we see the traded options converging not just to 0, but actually up to the synthetic options. The green line on the right is just looking at the difference between the two. Right? And so that difference between the two starts out very negative. The green, the shaded area is a confidence band, a 95% confidence band. That gap was highly negative and highly significant. That's a t-stat of like 6 or something for some of the most negative periods. And by the time we get to the end, again, they look like they've converged. But what is important to us is not just that they've converged, but which direction they've converged. Right? So you could have taken the view that back here in the early part of the data, so like 87 to 97, there's no way you could have dynamically replicated the options, right? That the markets were not that efficient, that you were trying to trade every single day. The S&P 500 futures market was a catastrophe in 1987. And so you could say, look, I couldn't do that. And that really the correct price, the price that we should be looking at to understand what investors think, you could say, well, look at the thing you can trade. I can trade that, which is I'm incredibly sympathetic to that point. But in that case, what you would have expected is that as the market became more liquid and as those synthetic options actually became feasible to trade, which way should the convergence go? You should think they should converge down to the traded options, right? That I should see that red line come down to the blue if the blue is the truth. And that's not what happened, right? The blue line went up. That premium on those synthetic, that's the premium on the traded options that you got. This is just the premium from put selling. That premium went away, and now seems like it's gone. And so we try to think about why. One view is that, so another view when we, like, again, we're sympathetic to the view that you can't do we're sympathetic to the view that you can't do this back here, that it's difficult to trade every day. It's expensive to trade every day. And so what does that mean? What it might mean is the options are overvalued because the people who are selling them, those intermediaries, are demanding a big premium to hedge them because it's expensive to hedge them. So we look at a couple things to try to think about that hedging. So what do you have to do? You're trading a lot to hedge them dynamically. So you would probably care, one, about bid-ask spreads. Here what we're plotting is back since 1900. I have the bid-ask spreads first on the Dow 30, going back to 1900. That's in gray. Used to be about 0.5% to 1%. That's just the posted spreads. That's just if you're small. The red line is for SPY, so for an S&P 500 ETF. The black line is for a Dow Jones ETF. Both of those, once we get decimalization, those are both just economically locked on to 0. It's nothing at this point. And so you can do that. And when can you do it? Somewhere around, say, like 2003, 2004. And so at a date that is, surprisingly contemporaneous, where when you start to see this premium go away. Right? That is about when things start to look easier to trade. So that's number one. That's one source of frictions in this market. You're trying to replicate these options. You're trying to dynamically hedge your options. You're going to care about these spreads. The other thing that you might care about is the gap between the futures price and the underlying index. Right? So what are you doing? You're a dealer. You're selling an option, and you're trying to trade the S&P 500 futures to hedge that. The problem that you face is the S&P 500 futures don't always perfectly match the index. So what we're measuring here, going back to the early 1980s, is the volatility of that basis, of the gap between the futures price and the level of the index. It's a log scale on the left-hand axis. And so this is actually a movement of about a factor of 10 over this period. That basis shrunk by at least a factor of 10. Depending on how you look at it, it might be a lot further. And where's this spike? What's this spike? So that's a spike where the basis went up by nearly a factor of 10. That's 1987. So the crash in 1987, the futures were underpriced by 20% for about 3 days. If you're trying to hedge a short position in options, that is a huge problem for you. On the other hand, you look at 2020, you look at 2008, we don't see any huge deviations of that magnitude, like nothing even close, again, smaller by about a factor of 10. So the other thing that has happened, in addition to it being cheaper to trade the underlying, is that the hedging instrument that you might use to try to dynamically replicate the option, right? This S&P 500 future has gotten much more efficient in the sense that it's much closer. Should be a way to shut that off. No, I did it. The S&P 500 future has gotten much closer to the index that you actually want to try to replicate. So what are we doing? We're saying there is something that we can learn from using the pricing argument comes from an arbitrage argument, right? Comes from saying, look, I should be under certain assumptions. I should be able to replicate the payoff of the option. We're just implementing that, and we're implementing it going very far back. And we're saying there's something you can learn from that. We try to think that through. And when we look at it, we get vastly different returns than we get from the actual traded options. But that's changed over time. And so we take two conclusions away from this. One is that it doesn't look like your average investor in the stock market, the people who are driving the pricing of that underlying, of the S&P 500, it does not look like those people are actually highly averse to high volatility periods or periods where there are crashes. Number two, if you're a person who studies these things, these returns look massively non-stationary, right? That if you're trying to think about pricing, it matters a lot what your sample is. And when we look over time at these returns, and if you look over time at papers that are looking at these returns, they actually get different answers. And they get different answers because these returns have been moving a lot, especially over the last 10 to 15 years. And so part of our point is that, even if you don't like anything we're doing, even if you think the whole replication thing is ridiculous and nobody could have ever done this and there's nothing to learn from it, at the very least, you need to be very careful about the sample that you're looking at because you're going to get very, very different answers depending on what that sample is. All right? So, thanks.
Well, before I get into the beef of it all, thank you, Andrew Lowe, for the invitation. It's such a pleasure to be here and honor Bob and Myron. Bob and Andy, by the way, were my advisors only 30 years ago. And I recall dearly those lectures. They were not lectures. They were fireworks with lots of aha moments. So I am in your debt in more ways than you think. Let me discuss the Dew-Becker paper. I like it for two reasons. I like it because it's elegant. It produces connections out of left field between concepts that you would think are unrelated, such as the slope of risk aversion to market returns and option alphas. I mean, who would have thought that these two concepts were intimately related? I like it also because it's balanced. You saw Ian's conclusion a minute ago. He finds lots of caveat emptors and immunizing clauses at every page of his paper. In a way, his own hardest critic. Reminds me of Robert Frost. He used to say that liberals are too broad-minded to take their own side in an argument. I'm going to recap my own understanding of the paper, okay? I want to recap the three main conclusions as I see them. Conclusion number one is that over the long sample, which is like a 36-year sample for options, the alpha of traded options is negative. And what it means is that risk aversion increases as wealth declines. Why is this an important topic? As Ian pointed out, it means that crashes are very painful. It means that a policy maker who's curious enough to look at these results will say, crashes verboten, okay? Crashes should be outlawed. Not Not a crazy assumption, by the way, if you have looked at the market over the last 20 years. Point number 2 of the paper is that if you rinse and repeat with synthetic options, you find 0 alpha or even slightly positive alpha. But obviously, we can only use synthetic options to recover the behavior of stochastic discount factors under a number of conditions that Ian points out. And the third finding of the paper is that traded option negative alpha went to 0 over the last 12 years. As trading frictions go to 0, as the equity futures basis goes to 0, so does the option alpha, okay? In other words, results from synthetics and traded options converge. Well, let me now make a few comments, okay? My first comment is about CAPM alpha, the CAPM option alpha. What does it mean? What does CAPM option alpha mean? Well, first of all, there is a measurement problem. Option returns are non-stationary. I mean, how do we apply all that fancy econometrics to non-stationary quantities? And number 2, I think maybe more insidiously, the model is likely misspecified, right? I mean, after all, if you look at a return attribution for traded options, it's not just about CAPM. We all know that a big portion of the returns has to do with the volatility risk premium. And the question is whether the volatility risk premium is closely related to the CAPM or not. And we know from papers such as, you know, the Constantinidis paper that that you need additional factors like the volatility jump and the like. And so if the model is misspecified, then it might well be that the alpha that we are measuring here is the beta of omitted variables or factors. That's, if you will, the comment number 1. Comment number 2, synthetic options. So let's go beyond the obvious. I think Ian very well discussed the fact that it would have been very difficult to replicate a put option in 1930. None of us is old enough to have tried. But the reality is, you know, going short the index when index futures did not exist and then landing in the market is not stuff that happened 80 years ago or 90 years ago at minimal transaction costs. But that's an obvious one. But what I also think is that, I mean, we always hear that options are redundant assets. I mean, of course, it's redundant to some extent, to the extent that, you know, you're disregarding the volatility risk premium. My prior is that once you start measuring the alpha on synthetic options that are linear combinations of Black-Scholes Merton deltas times the underlying and then some lending or borrowing, there is no reason to expect much alpha anyway. The alpha is going to be close to 0. I mean, the only source of alpha potentially is that you are conditioning on a stochastic process. And to the extent that you have some momentum over the period over which you are replicating the option, then, you know, to quote the Lo Wang paper, the realized volatility is going to be higher. And so to that extent, it's going to produce a little bit of positive alpha, which is what Ian finds. Then, you know, to the third point, which is that traded option negative alpha went to 0 over the last 12 years. I think on this one, I want to say this. I want to say that it has been the case that 2010, 2020 has shown a much lower alpha and much lower return for the volatility risk premium. But I think that the news of the death of negative alpha is premature in the following sense. What happened between 2010 2010 and 2020 that hurt the short gamma performance, in my view, is not just the convergence of the futures basis and the lower transaction costs, it is QE. I mean, think about what QE has done. QE has created positive time series momentum, which has increased the realized vol, and it has killed the demand for insurance, which has decreased the implied vol. So the volatility risk premium has decreased quite a bit. And guess what? Since 2020, in other words, since there are persistent calls of quantitative tightening, the implied vol versus realized vol basis has been restored. Actually, the last 3 years have been very prosperous for gamma sellers. When there's a Fed put, obviously demand for hedging falls, and QT is a game changer. So I would contend that the 2010-2020 period is just one data point, okay? It's just a single monetary policy experiment. QT is a game changer. Now we have record high leverage, record low equity risk premium. And so this is changing. And then remember that the volatility risk premium has to do with something very fundamental that has to do more with evolutionary theory, not with finance. It's linked to the primal fear of the sort discussed by evolutionary theorists, where you prioritize avoidance of danger no matter what. And as a result, you always highball the crash risk consistently. It's like the Dornbusch aphorism, crises build very slowly and happen all at once. Now, the other thing that killed the alpha of both volatility sellers and long-short equity traders is front running by dark pools, okay? As you know, order flow is skimmed by well-capitalized brokers with exchanges now selling access to order flows and becoming not just a marketplace, but also data repositories. They charge both the broker and the customer. By the time the transactions hit the exchange, the harm is done, and there's very little alpha left. So as long as the market rally continues, we're all fine. No one notices. But when QT hits the market in full force, investors will ask, so I've been spending so much on what? So, but the other more fundamental question is, whose alpha are we measuring anyway? That of Ken Griffin or that of my mother-in-law? Okay. I want to spend an additional 2 minutes, if you don't mind, because I have something totally irrelevant I need to discuss with you. Okay. We have talked a lot about alpha. It may be misspecified, it may be sample dependent, it may be relevant for all I know. But spare a thought for option beta, okay? I want to tell you what a simple Black-Scholes-Merton model is gonna say about risk aversion in a pathological case, which is the million-year option, okay? So humor me for a while, okay? I won't let practicalities get in the way of a good story. Here's what I want to discuss, okay? I think Bob taught me this 30 years ago when he discussed Zvi Body's paper on the long-dated puts. But here's something I imagined, okay? Let us say that you want to calculate the probability that stocks outperform bonds. What do you find? Well, you find this thing here, that the probability, which is a physical probability, is simply the cumulative of a Sharpe ratio minus half the vol, okay, times the square root of the horizon, okay? But if you want to calculate the risk-neutral probability, the martingale probability of this happening, then all of a sudden you have phi of minus sigma over 2 times square root of t. Now, what is this saying? This is saying that it doesn't quite jive with the idea that P and Q need to agree with each other. Here, asymptotically, they don't speak to each other. They diverge completely. Effectively, when the geometric return on the index is higher than the risk-free rate, then the probability of stocks outperforming is 1, but the martingale probability goes to 0. So what does this mean for options? What it means for options is that I can sell you something for 0 that will make $1 billion for you. And I can sell you something for $1 billion that will make 0 for you with probability 1, okay? So what are we talking about? Again, I live in the pathological world of a million years of expiry, but you know, it holds obviously as a trend. If you have a binary call that pays you, say, $1 billion future valued at the risk-free rate, if stocks outperform bonds, then we can show that the price is 0, even though the probability of exercise is 1. In other words, with probability 1, you get $1 billion future valued at the risk-free rate, and you pay 0 for that. And how about if you buy a call? Myron was discussing this yesterday. Well, you have to pay a full price for something that's going to pay you something with probability 0. You have to pay $1 billion. Now, why am I discussing this? I'm discussing this because I think it helps shed some light on risk aversion. What it's telling me is that, of course, the net present value of those instruments is 0. Of course, this is an efficient market. But my little finger tells me that if I ask people here in this audience, would you rather buy a call or a put? I would say 90% or more will buy the call. And in a very bizarre way, I think that's what the market is saying. After all, selling puts, which is obviously directionally like buying a call, is a national sport in the United States. I mean, insurance companies, banks, hedge fund managers, risk parity funds, governments, the public guarantees, you're hard pressed to figure out who's on the other side of the trade. Okay, thank you. Thank you very much.